When you buy a stock, you're not just buying a price on a screen, you're buying a slice of a real business. The big question is, are you paying too much for it? A great company can be a terrible investment if you overpay. On the other hand, a struggling company might be a great investment at the right price. That's where valuation comes in. Today, we'll break down the key valuation matrix, price to earnings, price to book value, and EV to EBITDA, and help you understand how to tell if a stock is overvalued or a bargain. Stick around till the end, and you'll have a simple yet powerful approach to valuation that even professionals use. Before we begin, make sure to subscribe to the channel so you don't miss the next videos in the series. Also, join our Telegram group where we discuss stock market insights, investing strategies, and answer your questions. The link is in the description. So what is valuation? Valuation is all about answering one simple question. How much am I paying for this business and is it worth it? Imagine two grocery stores are for sale. One costs 1 crore and earns 10 lakh a year. The other costs 2 crore but earns 50 lakhs a year. Which one do you think is the better deal? Just looking at the price is not enough. You need to compare what you're paying versus what the business is earning. Stocks work the same way. A stock price going up does not mean it's worth buying. A stock price going down does not mean that it's cheap. We need valuation matrix to understand the real worth of a stock. Price to earning ratio or PE ratio is the most popular metric. The PE ratio tells you how much investors are willing to pay for each rupee of a company's earnings. It is calculated as PE equals stock price divided by earnings per share, or EPS. If a stock has a PE of 20, it means that investors are paying 20 rupees for every 1 rupee of the company's earnings. But here's the catch. Looking at past earnings alone is not enough. A stock might have a low PE because its earnings are expected to fall, or a high PE because earnings are expected to grow. That is why professional investors focus on the forward PE ratio, which uses projected future earnings instead of past numbers. Think of it like this. If you're buying a shop, do you care only about how much it made last year, or do you care about how much it will make in the future after you buy it? A stock with a high PE but strong future growth might still be a good investment, while a stock with a low PE but declining profits might be a trap. Now let's talk about the price to book ratio, or checking the company's worth. The price to book ratio compares a stock's price to the company's book value or net assets. Price to book is calculated as stock price divided by book value per share. A price to book ratio below 1 suggests that the stock is selling for less than the company's assets, which might indicate a bargain. But it's not that simple. Some businesses, like banks, rely on assets, while others, like tech companies, rely on intellectual property. So price to book is more useful in asset-heavy industries like banks and manufacturing than for technology stocks. Now let's talk about EV to EBITDA, or the smarter valuation metric. Enterprise value to EBITDA, or EV to EBITDA, is often preferred by professionals because it includes debt in the calculation, unlike PE. EV to EBITDA is calculated as market cap plus debt minus cash divided by EBITDA. A company with high debt might look cheap on a PE basis, but it could be a ticking time bomb if debt levels are too high. EV EBITDA adjusts for this, making it a better metric for comparing companies with different levels of debt. Now, there are some valuation traps you need to avoid. First, a low PE does not always mean cheap. It could mean earnings are shrinking. Then, similarly, a high PE does not always mean expensive. It could mean there is strong future growth potential. Price to book is useful in asset-heavy businesses but misleading in tech companies. EV to EBITDA can help, but you must check debt levels to avoid companies with financial trouble. No single metric can tell you the full story. You need to compare multiple factors. Now, how to use valuation in stock picking? Always compare valuation matrix within the same industry. A bank's PE cannot be compared to a software company's PE. Look at historical valuation trends. Is the stock cheaper or more expensive compared to its past? And combine multiple metrics for a complete picture. Never rely on just one. Now you know how to determine whether a stock is fairly priced, overvalued, or a bargain. But valuation alone is not enough to decide on an investment. A stock might look cheap but have weak financials, or it might look expensive but be a strong growing company. That's why stock picking isn't just about looking at one factor. In the next video, we'll analyze financial health, how to check if a company is stable, well managed, and built to survive tough times. Now, what's the first valuation metric that you check when analyzing a stock? Let me know in the comments. If you found this useful, hit that like button, subscribe, and turn on notifications so you don't miss the next videos in the series. I would also request you to join the Telegram group where we discuss such ideas. And for more investing decisions, let's keep connected. The link is in the description.